Adobe just beat on revenue, profit. It is up 14.5% after hours. I had puts on Adobe at about $4.25 per share. Those are not going to get exercised anytime soon. Now, they reported $4.48 per share in earnings per share versus $4.39 expected. So they beat, but not some astronomical number, and $5.31 billion in revenue versus $5.29 billion. Again, they beat, but by $20 million bucks. Not a ton. But they increased their expectations for next quarter. They're now estimating $4.50 to $4.55 per share in EPS and $5.33 to $5.38 billion in expected revenue next quarter. As you've seen a lot lately, a lot of companies come in and their guidance drives the after hours movement. I'm sure they're going to have a call today where they're going to answer questions from investors, and it's very exciting. I think Adobe is one of the most exciting software businesses out there. Great balance sheet, $209 billion market cap versus a $216 enterprise value. That difference is essentially the debt of $6 billion. And guess what? They generated $6.5 billion last year in free cash flow versus their net income of 4.8. So more free cash flow than net income. I mean, guys, Adobe owns the world of Photoshop, all these other things. These graphics, it's just, people love Adobe, and they've done a great job from converting from buy this CD and pay $300 for this to, hey, pay us 20 or 50 bucks a month and you get all of everything. I think it's wonderful. You know how much I love subscriptions. We have our own subscription model here. That's how great it is. I think Adobe's up there with Microsoft in terms of amazing company. But just because it's amazing doesn't mean that it's perfect and should be bought. I'm on Twitter at @EMPaulG. Follow me there. Today, I got a comment from somebody. I posted about Tesla, and somebody said, hey, I still think it's possible to think a company is not a good investment, but a great company. I took it to mean that they didn't think I thought that was the case. Quite the opposite. I absolutely think that's the case. The reason investors get in trouble is because they equate company they love and think automatically great investment. No. Every investment is the present value of all future cash flow. And you've got to look at what you're buying and what can it grow into. And somewhere along the way, you have a certain return you're going to get from that. I'm here to teach that process of thinking. So if you've made it this far, you like what we're doing, on this Everything Money 24/7 channel, we do 4 or 5 updates per week on the economy, on earnings releases, everything. So if you like that, please subscribe. Our main channel, we do more stock analysis. But guys, Adobe, I will never deny being an amazing company. The first line of Adobe's press release on their earnings, company raises annual targets for digital media net. First line, guys. There's a reason why they're doing this. Oh, they're in San Jose. That's exciting. Okay, record revenue of $5.31 billion, driven by strong growth across Creative Cloud, et cetera, all the cloud stuff. Second quarter highlights, the $5.31 billion, diluted earnings per share of $3.49 on a GAAP basis and $4.48 on non-GAAP. That's the one we reported right here. GAAP operating income second quarter is $1.89 billion, non-GAAP $2.44. Cash flow from operations, $2 billion almost. So they do that 4 times, it's almost $8 billion versus the $6 billion they're doing right now. So 25% potential growth here in free cash flow. Let's compare it to last year, 1.94 cash from operations. Let's go check out what they were doing before then. Oh, it's actually down. Guys, it's actually down from last year. I'm showing $2.02 billion in the quarter ending May of 2023. They're reporting $1.94 billion. All right, so it's a little bit down. That could be for several reasons, but one thing I love, guys, these capital expenditures, they're nothing. $37 million on 1.17, $47 million on 1.6. This is like 2 or 3%. It's not a capital intensive business. This is a business that's awesome. Remember 100 years ago, you wanted to make money? You got to build a factory. You got to hire 1,000 people. You got to do all these things. Now, we're going to see a future now where we talk about everything money. I don't know how many guys we have here about everything money. 7, 8 guys working here, 7, 8 people working here. If we were 10 times bigger, guess how many people would be working here? 7 or 8 people. If we were 100 times bigger, guess how many people would be working here? 7 or 8. Now we probably have 10 or 12. I don't know. More developers. But the point is, the new economy allows us to do this. This is the only way in which I see justification for higher multiples, because as companies become less and less labor intensive, less and less capital intensive, you can really compound those earnings with a lot less effort. Now, the other flip side is somebody in their basement can sit there and write a program and change your entire business. That's the downside of that. 100 years ago, you wanted to compete with Ford or GM, you better have a lot of money to do that. The world of just starting up your computer and typing in some code and making it work did not exist back then. So there's pluses and minuses to all of this. Do they outweigh each other? This is why I like to focus on bigger companies. It's much less likely that Joe Smith sitting in his basement is going to be able to compete with Adobe. Much less likely. Is it possible? Of course it is. Now, I mentioned later in the video about buying back 4.6 million shares. I mean, I think in this quarter that was probably okay because the stock was coming down a little bit. But we have to see in Stock Analyzer tool later what fair value is. But if this is a company that can compound and compound and compound at really high rates of return, this might be value creation. But I think companies are a little too eager to buy back shares because the retail investor loves it. I get apprehensive about that. They should buy back shares when things are so dirt cheap. And some companies that have done that very, very well, NVR, AutoZone, O'Reilly Automotive, those guys have done that really, really well and become 100x on their stock price while the business is only up 5 or 6 times. That's how you appropriately buy back shares. Here are their targets for third quarter. Talking about before, revenue 5.33 to 5.38. Tax rate, who cares? Earnings per share, 345 to 350. GAAP, 450 to 455, like I told you guys before, non-GAAP. Their fiscal year targets now, 21.4 to 21.5 billion. Let's see how that compares to how they did in the last 12 months. Slight increase, because we're at 19.94 billion over the last, so it's probably a 10% increase on the high side, 7 or 8%, which by the way, that's okay. You can make a lot of money on companies like this with high gross margin, being able to compound at and only growing 7 or 8%. That's what's great about these companies. All right. And they're expecting non-GAAP earnings per share of 18 to 18.20 per share. Okay. So guys, this company is pretty exciting. Let's go see what the analysts are saying about the company. 18.39 this year in EPS, growing to $30 over the next 4 years. Guys, that's double-digit growth. According to analysts, Warren Buffett always says that whenever he sees an analyst report, he ignores it unless, of course, he couldn't find the comics that day in the newspaper. Then he starts reading analyst reports. I like to look at analysts just to see where is the market feeling right now. For revenue growth, 21.9 to 33 billion, 10, 11.5, 11.5, 10.5, 10.5. Big revenue growth numbers. Adobe can do that. Look at this. For those of you who are new, return on invested capital, 19%, 23% last year, 19% over the last 5 years. This is the sign of a great company. This is a sign of a good and great company. You absolutely need to pay a premium for companies that have this, especially when they have growth potential. And Adobe still has a lot of growth potential. Adobe is on my list of 33 companies that I want to own at some point in the future because I don't think Adobe is going anywhere. And as the world becomes bigger and more economically rich and more people in other areas of the world that are poor get computers, this company will dominate with them. And that's what I love about Adobe. But 32 times price to free cash flow, 43 times PE. Is that rich? I don't know here. It's hard to say. But look at this, all-time high of $700 back in November of 2021. That's almost 2.75 years ago. They still haven't reached their all-time high. Yet the business is better than it was 2.75 years ago. Why? Well, we had that bear market for 1 year. Remember that? You guys remember what a bear market is? I don't either. But we had that bear market. Went from a high of $699 to a low of $275. Over a, 60-70% drop. And we recently had a high of 638.25 on February 2nd of this year. Hitting a low of 434 just 4 months later. Isn't that incredible? 434 just 4 months later. I got so close to getting my put. Look at that. I got so close. My puts were sold for 425. I was so close to getting my shares. Ah, well, wasn't meant to be. Now, was that 425 a little aggressive? Well, let's go see what our good old stock analyzer buddy does. Here are my assumptions. I do think these are aggressive assumptions, 6, 10, and 14% revenue growth. I really should do like 6, 8, and 10. Let's keep that for now. I'm going to focus on free cash flow margin since the free cash flow is greater. And guys, I want to remind everybody, I love when people say, oh, I'm a value investor, I'm a growth investor. Guys, value investing is growth investing. Growth is just how fast the revenue is going to grow. Value investing is taking that revenue growth and bringing it back to day one, saying, what's the right price to pay for that amazing revenue growth? First line in Stock Analyzer tool is revenue growth. First line. I love increasing ROIC over the last 10 years. That's awesome. PE, 18, 21, and 24, and my desired return of 9%. Now, somebody on Twitter the other day said to me, Paul, what happened to 12% you used to do? Here's why I changed on that. One, every company is different. 12% versus 9%. I can't assign a margin of safety on every company across the board. So what I've decided to do was, what's this thing worth if you get the desired return of 9 or 10% in the market? It's on you to put in your margin of safety. If you know Adobe inside and out, you should have a lower margin of safety potentially than somebody like me. Their operating margins on this company in 2013 were 11%. It's now 35%. This is a well-run company. Now, I'm quite sure there's going to be some share buybacks. Get a little apprehensive about those. You know how I feel about share buybacks. If you buy back shares that are expensive, you're destroying shareholder wealth. If you buy back cheap shares, you're creating shareholder wealth. These are some of the things that are very important. Now back to Stock Analyzer. You need to put margin of safety in here for a couple reasons. One, if you just want 9 or 10%, buy a low-cost ETF. There's no reason to buy stocks, individual stocks. The market, don't even worry about what's going to happen today or tomorrow or 10 years from now. Just buy low-cost ETFs. So if you want an individual company, make it worth your while. Buy it when the return is much higher, where you're like, listen, this is going to crush the market over long periods of time. That's what's key. And also, valuation is an art. Humans, we are still humans. We make mistakes all the time, and the future is unknown. This is why you need margin of safety. Boom. Low price of 356 based on free cash flow. High price of 900. Middle price of 567. So after the big shoot up, it's getting pretty close to my fair value here. Guys, 2 things. Subscribe to the channel because next week we have a huge week of videos. We got a lot of videos coming out on this channel. Thank you for your time.